Welcome back to Lem's Cryptoverse. Today we're going to talk about something that's an intermediate level finance, and we're going to be talking about modern portfolio theory. This is part 2. If you haven't watched part 1, do it now. So where's your video? Where's your coin on this chart here, on this efficient frontier? Is it in the middle? Is it on top? Are you getting the most bang for your buck? Well, today we're going to talk about how MPT, modern portfolio theory, does not apply. You cannot use it for crypto, but I'll show you another way, like a backdoor way of using MPT or using the whole process or concept, I should say, of risk. So let's just review MPT quickly. The definition basically says that this theory from Markowitz, 1952, basically says that you can maximize your portfolio return per given level of risk. And it does that, it accomplishes that by the concept, which actually works, of diversification. Diversification is basically a portfolio allocation strategy that allows you to minimize idiosyncratic risk or unique risk by holding lots of different assets that are not positively correlated. So they have correlations that are less than the absolute value of 1. And that's basically the correlation coefficient that you would study in the CFA Institute program. There's no joke, of course. The joke is that diversification works, except when you really need it, right? They say that all correlations lead to 1 when there's like a economic crisis going on, kind of like what's going on now in September. So portfolios can be diversified in multiple ways. And this is a key point. You need to, in order to have this theory work, you need to invest in different asset classes and different markets, basically, in countries at different risk levels. So if you invest in Tesla and Ford, that's not going to help you in any way. So what's the efficient frontier? I showed you that earlier. It's that curve that maximizes your return per unit of risk. And in this case, we're talking about portfolios, so it's not a risk of an individual stock, it's portfolios. Next slide. So here's the efficient frontier. So you want to be invested in portfolio A, for example, versus portfolio B, because A has the highest expected return. You could see it there on the y-axis, the expected return. There's a higher expected return for portfolio A than there is for portfolio B. And I made it simple for you here. I made it so that they have the same risk. And in this case, the risk is about 10%. Problems. Now here it's really important. Now there's a whole bunch of problems using MPT for any asset class. And I don't think it even works for equities, but for our presentation, we're going to be focusing on the ones that really don't work, not just for equities, but for crypto. So we're just going to go over a few. The first one is, it assumes, and I'm reading this bullet number 1, that it assumes that investor is adding portfolios. Now, if you watch YouTube videos on MPT or talk to a wealth advisor, they're going to talk to you about diversifying your crypto portfolio by buying Bitcoin and Ether and Solana and Avalanche and Phantom and Ripple and Litecoin and and so list goes on and on. Why? Because we have something like 19,000 coins. But you know what? You cannot use individual coins to diversify MPT. It's about portfolios, so it's not going to work. Number 2, it assumes that the market is efficient, that asset prices reflect the underlying values. And we don't even know if this works for stocks, right? And we saw what happened back in, when was it? This goes way back now to February 21, with the meme stocks, the Robinhood stocks. Those stocks like GameStop and AMC and Best Buy, I should say, did not reflect true underlying values. And if stocks don't reflect values, underlying values, you know that cryptos definitely are not going to reflect any sort of value. Point number 3 is that investors are risk averse, but sometimes it seems that investors are risk seeking in the crypto world. It also assumes that diversification is possible to reduce risk, but in crypto land, or the cryptoverse, I should say, that is not possible. All cryptos are highly correlated with Bitcoin, so you cannot diversify away risk by buying different types of cryptos. And I underline the next point. It assumes a normal distribution of returns. But in crypto, you get like what people like to call pump and dump, right? They pump up and sometimes they flatten and then they go up again like a staircase. Or they pump up and then they dump, they go down. So what they have in when I was studying for my FRM, there was something called serial correlation. So what they have is that they tend to move. There's like a relative strength factor. So if a particular coin goes up today and tomorrow, it's more likely to go up the next day. So there's like a trend following in crypto. So that is not a normal distribution of returns. And then there's some other points here. The market portfolio. Do we even have a market portfolio for crypto? What they're using now is Bitcoin. They're using Bitcoin as a market portfolio. I would argue that is not the market portfolio. So you can do that with stocks, because with stocks, you can buy Ford, for example, and you could say that the S&P 500 is the market portfolio, but they don't have something like that, or they're not using that concept in the black boxes of the Monte Carlo simulations of crypto. And what else here? I'm trying to see which ones may apply mostly to crypto. Here's one, volatility. This is the third point from the bottom. Volatility does not change over time. That is not true. Volatility itself has particular regimes, where sometimes you get high volatility and sometimes you get periods of low volatility. And MPT assumes that all risk is bad, and that's not true. And the last point is that investors have the same time horizons. That's not true, especially in crypto. It seems that there's like these hodlers, right? And then there's investors that have very short time horizons, right? The pump and dump investors. So that point is moot. Investors do not have the same time horizons. So what's our solution? If you cannot use modern portfolio theory, then what's our solution? So I said here in the first point that understand that cryptocurrency investors cannot duplicate, so they cannot mimic what's done with equity portfolios using crypto. They cannot rely on historical volatility. In this case, I call it beta. I think some CFAs are going to be a stickler for me using the word beta. I want us to use the word beta, but really, beta should only be used when you have a diversified portfolio. So I'm using the word beta loosely because everyone understands the concept of beta, right? When you have a beta of 1 with S&P, it means your asset is moving 1 for 1 with S&P. So if the S&P goes up 10% in 1 year, your asset's going to go up 10% because you have a beta of 1. So that's the concept of beta I'm using for the purpose of this presentation. So what I think we should do is designate 3 cohorts of risk, or 3 tranches of risk: low, medium, and high. So here's how I'm going to designate those cohorts of risk. I'm going to make all the top 10 coins a low risk. And these are the projects that we all know of. Like, maybe I shouldn't say, I was going to say Ripple, but that's probably a risky one. Ripple and Solana and Ethereum. These are large, well-known projects. They have strong funding. Some of them have as much as $500 million in funding from VCs or from their ICOs. And speaking of VCs, there's a lot of support by venture capitalists, including Mark Andreessen. And so they have lower than average risk. But still, you need to assess the risk, because there was a project that I did not like called Terra Luna, which is a huge project, top 10 project, growing rapidly, but they still had huge regulatory and they had platform risk. Because remember, it was an algorithmic stablecoin, and many observers said that didn't work, and they were right. So this is low risk. Now we're going to look at the other cohort, medium risk. So these are the 20 to 30 market cap coins on coin market cap that we know of, like Elrond, maybe Elrond, or definitely Phantom is a good example of that. And they have good funding. They still continue to be well known, and lots of venture capitalists in them. And one way, if you're not sure if it's a medium risk, besides checking their market cap to see if they're top 20 or 30 market cap and coin market cap, you can look at their yields. If their staking yield is like 15-20%, you know that's a high risk, and maybe it's not really a medium risk project. And then there are the largest risk projects. This is the third cohort of largest risk. This is, like I have said here in the bullet, number one, these are small projects. These are the, whatever it is, 10, 15,000 projects that are smaller than it being ranked the 30th project. They're not well known. People don't know them. They have hardly any funding. And you can look up the funding. They have websites where you can look up the funding, or you can look them up in Missouri, for example. And you want to make sure the staking yield's not too high, because remember, if you're getting a high staking yield, it means something's wrong. You don't get high yield for nothing. Maybe there's inflation, maybe there's risk in the crypto project. And I have a list of other risks out there, and you can read them on your own time. But one of them is technology risk, bridge risk, hacking risk. Maybe they're too centralized. So then after we figure out what the risk is of each of these projects, whether large, medium, or small, what we do is we place a beta for them. So maybe we'll put a beta of 1 or 1.2. I put 1.2 here for the ones that are large caps. And medium for the ones that are medium cap. And in small, for small caps, I put a beta of 2. So I just noticed as I was speaking with you that maybe this is the reverse of what I said earlier. So when I said large, medium, small, I was talking about large cap, and medium cap and small cap. But actually the biggest risk, or the largest risk, obviously, is with the smallest caps. So just keep that in mind. So the small would be red, and the medium yellow, and the large cap would be green, and on that red line tachometer that I showed you. So in order to do this, you're probably figuring out right now, it requires that you need to know the individual project well. You can't just look at charts. You have to know the project, from its beginning, from its founding, and then you have to keep monitoring over time. And then you have to look at the betas. Make sure the betas make sense. For example, if you give a beta to your project of 1.2, like I have up here, and you're checking it with its peer group, and it doesn't make sense, you have to reassess it. So I'm going to give you, maybe I should just give you a real example. Let's say you're looking at Avalanche or Solana, and you gave it a beta of 1.2, but then you're checking it against other layer 1s, and you notice that Avalanche, for example, its token is moving 3 times faster, or it's 3 times more volatile than Solana. Then what you need to do is increase that beta. Okay? And so that's how we're going to do it here. So I think we covered everything. Okay, we covered almost everything but returns. So in modern portfolio theory, what they do with the black boxes, those Monte Carlo simulations, they have an expected return and risk. And they do this going forward based on historical return and risk or projected return and risk. So we're going to forget about the return. All we're going to be focusing on is risk. And we're going to be looking at risk in terms of beta. Do we have a high risk, medium risk, or low risk? If we have a high risk, we're going to use a high beta. If we have low risk, we're going to use a low beta. And this is going to be a low beta compared to Bitcoin. So if there's a low beta of 1.2, we're going to say that our project moves with a beta of 1.2 times that of Bitcoin. So if Bitcoin goes up 10%, our asset is going to go up 1.2 times that, or 20% more, basically, than the return of Bitcoin. So 20% more than Bitcoin. Bitcoin using beta is 1.2 times the beta of the return of Bitcoin of 10%. So that's 12%, right? It'll move 12%. So I hope this is clear. I know it's a lot. So what I would do is I would review the slides. And if you have any questions, please put them in the comments. And thank you all for listening. Bye-bye.